Imagine you are walking through Wall Street on a crisp morning, suits and briefcases everywhere, screens blinking green and red, the hum of trillions of dollars flowing invisibly beneath your feet. You overhear someone say something that stops you in your tracks. They say investing in index funds is the largest financial bubble in history, bigger and more dangerous than the internet bubble, bigger than 1929, and some even claim it is the thing that will destroy modern investing altogether. It sounds dramatic, but influential voices, market commentators, and even legendary investors are whispering variations of the same concern. They are pointing at the S&P 500 and saying this time it is different. This time it might end badly. Today on the Calm Capital Historian, we are going to cut through the noise, separate fact from fear, and explain what is actually happening with index funds, why people are worried they could be building a bubble, and perhaps most important of all, what that actually means for you as an investor. Stick with me until the end because we are going deeper than headlines, deeper than clickbait, and deeper than fear. We are going into the economics, the history, the psychology, and the practical reality of how index investing works, why it matters, and how to think about it rationally rather than emotionally. Let us start with the basics because if you do not understand the foundation of the structure, everything else feels mysterious and intimidating. In the world of investing, when someone says a fund, they mean a basket of stocks or assets. Whether it is labeled an index fund, a mutual fund, or an exchange-traded fund commonly called an ETF, the underlying idea is the same. Instead of you going out and buying one company's stock all by yourself, you buy a share of a collection of stocks all at once through the fund. Imagine you go on your brokerage platform and want to buy stock in a major company like McDonald's. You type in the ticker symbol MCD and you can buy one share of the McDonald's Corporation directly. You then are the owner of that share, and your investment rises and falls with McDonald's alone. Now imagine you do not want to own just one company. You want exposure to tens, hundreds, or even thousands of companies with a single purchase. That is where funds come in. You could buy a fund that holds companies like McDonald's, Apple, Google, Microsoft, Amazon, and many others all at once. This fund might own a little bit of each company, allocating investments across the entire basket. There are funds that cover almost every imaginable category of investment. Some give exposure to the S&P 500, which is the 500 largest publicly traded companies in the United States by market value. Some give exposure to technology stocks. Others focus on healthcare, international markets, real estate, or emerging economies. Almost every major investing philosophy for the last 3 decades has agreed on one thing: diversification is safer than owning single stocks. That idea has led trillions of dollars into index funds, especially those tied to the S&P 500. Now that we have the basics, let us talk about why some analysts, commentators, and even well-known investors are starting to raise alarms. They are not saying index funds are bad in theory. They are saying the sheer scale of money moving into them may be creating distortions that could have negative consequences. There are 4 primary concerns that these investors point to: concentration of money in a few stocks, price insensitivity, asset insensitivity, and lack of investor experience. Each of these concerns has layers and implications, so let us explore them one by one. On the surface, the S&P 500 sounds diversified because it contains 500 companies. But the reality is far narrower than the number would suggest. You see, index funds are weighted by market capitalization. That means the largest companies by value get the biggest share of all new money flowing into the fund. In simple language, if investors pour money into the S&P 500, the money does not spread evenly across all 500 stocks. Instead, it flows mostly into the largest companies by market value. Right now, the 7 biggest companies in the S&P 500 by value are Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, and Tesla. Together, these 7 companies account for roughly 1/3 of the entire S&P 500 by market weight. 1/3. That means 1/3 of the entire index is essentially dominated by 7 names. Within that group, Nvidia alone accounts for about 7% of the entire S&P 500. That is extraordinary for a single company. The next largest companies by market value are smaller, but still significant. What worries some investors is that this creates a kind of passive feedback loop. Here is how that loop works. When you put money into an index fund, the fund must use that money to buy stocks in proportion to their weight in the index. Because the largest companies have the biggest weights, a huge fraction of every new dollar entering index funds ends up in the biggest names. That means buying drives prices up for those large companies. Rising prices make the company worth more, which increases its weight, which then forces index funds to buy more of it, which pushes the price higher still if demand is strong. Now imagine expectations start growing that these companies must forever keep delivering rapid growth and earnings just to justify their elevated price levels. That puts pressure on the companies, but it also creates a fragile situation where high valuations are being justified on faith in continued performance rather than actual financial results. If these companies fail to meet expectations, or if earnings slow down, the stock price could fall sharply. And because these companies are such a large portion of the index, a fall in one or more could drag the entire index down with it. That, in essence, is what people mean when they worry that index funds might contain concentrated risk even though they are called diversified. A fund can be diversified in name, but still be effectively concentrated in practice if a handful of names dominate its structure. This concern goes deeper into how people actually think when they invest passively. When someone invests in a single stock like Apple, they typically pause and consider questions such as, is the stock price expensive relative to its earnings? Does the company have strong growth prospects? They are somewhat sensitive to the price they pay because it matters for potential returns. With index funds, that careful price evaluation tends to disappear. People do not think about the valuation of Apple or Microsoft or Amazon individually when they invest in an S&P 500 fund. They simply buy it, without asking whether the underlying companies are expensive or overvalued. Index investing removes price sensitivity. People put money into the entire market without thinking about the valuation of individual components. That is good for emotional discipline in many ways, but it can also push valuations higher because it reduces the natural check that comes when investors question whether a company is fairly priced before buying it. Right now, the S&P 500 is trading at roughly 29 times earnings on average. That means for every dollar of earnings a company generates, the market values that dollar at $29 of market capitalization. Historically, the average valuation has been closer to roughly 20 times earnings. That does not prove disaster is imminent. Markets can remain above historical averages for a long time, but it does show that price sensitivity is lower than usual and that investors are comfortable buying assets with valuations above historical norms without paying attention to price. Some see this as a symptom of complacency or even irrational belief in continual market growth. Index funds do not pick stocks based on what the business actually does. They are simply tracking a list of companies selected by criteria like size or sector. This means that when you buy a share of an index fund, you also automatically buy shares in companies you may not know anything about or even care about. You own the biggest tech giants, sure, but you also own the lesser-known companies that most investors have never even heard of. When the S&P 500 includes something like Match Group Incorporated, Mosaic Company, or other relatively obscure names, money flows into those companies essentially by default. Investors do not ask, is this company a good business? They simply own it because the index holds it. This is what people mean by asset insensitivity. Investors in index funds may not even know what they are investing in beyond the biggest names. Yet their money helps drive price increases even in the obscure corners of the index. Again, this is not inherently bad if markets are generally healthy, but it can distort valuations because companies with very different underlying fundamentals all receive investment dollars at the same pace regardless of their prospects. Lesser-known companies get valuations that may not match their individual business realities. The final concern investors raise about index funds is related to the psychology of the people investing in them. Passive investing has grown enormously in the last few decades. That means more and more people are investing without ever learning how markets behave in downturns, or what valuation really means, or how to think critically about financial assets. When markets crash or valuations contract, inexperienced investors are more likely to panic, sell their holdings at the worst time, and lock in losses they would have avoided if they had even a basic understanding of market history. History has shown again and again that markets are cyclical. Over the past century, the United States has experienced more than 16 recessions and at least 25 market corrections defined as declines of 20% or more. These cycles do not happen because investors suddenly become experienced and rational. They happen because human emotion is constant, and markets are driven by human behavior on both the upside and the downside. Inexperienced investors may not have the discipline to hold through downturns or to take advantage of opportunities created by market stress. That compounds the problems of price and asset insensitivity by turning theoretical concerns into real financial harm for ordinary people. Now let us cut through the emotion and ask the question everyone wants an answer to. Are index funds a bubble that is going to burst and ruin investors? Short answer, maybe. Long answer, not exactly in the way people fear. Yes, there are good reasons to be thoughtful about investing in index funds. Yes, a disproportionate share of money is going into a handful of stocks. Yes, investors are not sensitive to price in the same way they once were. And yes, many people lack the experience to handle volatility. But that does not automatically mean the entire structure is about to collapse in catastrophe. Bubbles in history like the tulip mania or the internet bubble had very specific characteristics, such as rampant speculation in assets without underlying earnings or usage, crazy leveraged bets, and a belief that prices could only ever go up. Index funds are different. They are not speculating on a single industry or a fleeting narrative. They are investments in the broad economic engine of the United States and global markets. To be clear, there are risks, but there is also a probability of continued growth over the long term based on fundamental economic output, earnings, productivity improvements, and innovation. So let us break down what this actually means for you as a thoughtful investor. If you would like the rest of the script without titles, I can continue right where this leaves off. Just say the word.